Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update on what's happening in the Chinese economy. If you've been following the channel, you'll be aware that inflation is a major problem in China. But unlike the rest of the world, where we've seen high levels of inflation over the course of the last 18 months, the problem in China is that they don't have enough inflation, and the country is now on the verge of deflation or disinflation, where prices actually start to fall. And whilst you might think that falling prices would be a good thing in terms of making things cheaper for consumers, it's actually bad news for the economy. So in today's video, I'll have a look at the latest inflation data that's been released by China. We'll have a look at what's happening with the producer price index or the factory gate prices, because that's absolutely critical from China's point of view. We'll have a look at what's happening with Chinese interest rates, what's going on with regards to the currency. We'll have a look at the Purchasing Managers Index, which gives us an indication as to whether business is expanding or contracting right now in China. We'll look at what's happening with business confidence. And then finally today, I'll wrap up with my summary. So what I think is likely to happen for the Chinese economy over the course of the next 3 to 6 months, and what the implications of this are for the global economy. This chart shows the movement in inflation in China over the course of the last 12 months. So as you can see, back in July 2022, inflation was running at 2.7%, which is considered to be a healthy rate of inflation. Most countries around the world have a target rate of between 2 and 3%. And the reason that most governments set inflation targets at around those levels is that it allows an element of growth. If you're a company, you want the flexibility of being able to increase prices, firstly to pass on any cost increases that you're incurring, and secondly to be able to increase the wages of your staff. So this time last year, the rate of inflation was exactly where the Chinese authorities wanted it to be. And in August, September and October, the rate of inflation stayed within that 2 to 3% bracket. However, in November, China experienced a contraction in its economy, and inflation fell to 1.6%. It then increased to 1.8% in December and bounced back to 2.1% in January. Now, January was the first full month following the removal of all of the COVID restrictions that the Chinese authorities had imposed for 3 years. They were still putting whole cities into lockdown. And at that stage, it looked like the Chinese economy was going to bounce back strongly and that 2023 would be a very good year for China. However, as you'll be aware, the recovery didn't last as long as everybody expected, and inflation fell to 1% in February. It then fell to 0.7% in March, 0.1% in April. It increased slightly to 0.2% in May, and in June 2023, the official rate of inflation is 0%. So that means that on an annual basis, prices in China today are at exactly the same level as they were 12 months ago. And that is obviously bad news for all Chinese businesses, because it means that they can't increase their prices. So they can't pass on any cost increases, and they can't increase the wages of their staff without affecting their own profits. And if you take a step back and look at the trend of this chart, you can see that in 2023 there has been a sharp downward trend in the level of inflation. And if we extrapolate that trend throughout the rest of 2023, it's highly likely that China is now going to see disinflation, that we will see falling prices. And of course, that will be a big challenge for all of the Chinese corporates, because if they've got falling prices, but their costs are going up, then that means that they will start seeing falling profits. And that's going to be a major problem for the Chinese economy. And to put China's current situation into perspective, this chart shows the current rates of inflation for the G20, the 20 largest economies in the world. And I've ranked this from the lowest to the highest. So you can see that China currently has the lowest rate of inflation out of all of the G20 at 0%. The next highest is Switzerland at 1.7%, Spain at 1.9%, Russia at 2.5%. And if you've been following the channel, you'll know that I've been questioning that official rate of inflation in Russia, because the Russian ruble has tanked in value over the course of the last 12 months. We have seen the ruble fall against all major currencies somewhere between 40 and 60%. So that means that all of the imports that Russia are having to buy in will be considerably more expensive. And usually when we have a situation like that, we have high rates of inflation. So the 2.5% does look a bit unusual. The next highest rate is South Korea at 2.7%, Saudi Arabia 2.8%. The official rate of inflation in Japan is now 3.2%. And that's really interesting because for the last 10 years or so, Japan has been suffering from disinflation, falling prices. And that's been a major problem in the economy. But we're now seeing prices rising, but that doesn't mean that the problems in Japan are over. Canada has the next highest rate at 3.4%, which is a considerable fall against the 4.4% the previous month. So there is definitely a movement downwards in inflation in Canada. Indonesia, 3.52%, Brazil, 3.94%. The USA's official rate of inflation is now 4%, which is a major fall from the previous month of 4.9%. India's 4.25%, France 4.5%, Mexico and Singapore 5.1%, the European area 5.5%, Netherlands 5.7%, South Africa 6.3%, Germany and Italy 6.4%, Australia 7%. Inflation in the United Kingdom is 8.7% as it suffers from a combination of high international prices and the impact of Brexit. And then we have Turkey at 38% and Argentina at 114%. And if you take a step back and look at what's happening for the G20, you can see that there is a clear trend in most of these economies for a reduction in inflation. For the last 18 months or so, we've been talking about high rates of inflation causing major problems in all of these economies. So everybody's been focused on trying to get inflation back down. But if you look at what's happening in China, it's gone too far the other way. Inflation is now so low that it's causing other forms of problems. And it'll be really interesting to see what happens for all of these other economies over the course of the next 3 to 6 months. Because if we do go into a global slowdown, as could be indicated by what's happening in China, it might be that we start to see inflation come tumbling down in all of these other economies, and that we go from one extreme to the other, and that low inflation starts to cause other problems. This chart shows the annual movement in producer prices in China over the course of the last 12 months. And producer prices are also known as factory gate prices. So these are the prices that companies are selling their goods for. And as you can see, back in July 2022, producer prices had increased 4.2%. In August, that level came down to 2.3%. And in September, it fell further to 0.9%. However, from October onwards, what we can see is that producer prices in China actually moved into negative territory. So producers were having to sell their goods at a lower price than they were 12 months previous. And obviously that is going to cause problems for any producer because most companies have rising costs. And so they want to keep increasing their prices. If you have to start cutting prices, then generally speaking, it means that you're having to compete harder to win that business, and it's likely to eat into your profits. So Chinese producers experienced a fall of 1.3% in their prices in October and November. The fall in prices actually reduced to 0.7% in December, 0.8% in January. However, in 2023, things have started to get progressively worse for Chinese companies. In February, prices fell by 1.4%, in March 2.5%, in April 3.6%, in May 4.6%, and the figures for June 2023 show that on a 12-month basis, producer prices have fallen by 5.4%. So that means that on average, companies in China are selling their goods today for 5.4% less than they were this time 12 months ago. And if we expand the chart out to show the position over the last 5 years, you can see that the current fall in prices is actually worse than it was during the COVID-19 pandemic in 2020. So that really puts into perspective how serious this situation is. Now, over the course of the last 18 months, we've talked a lot about how to deal with rising inflation. And the traditional method of tackling high inflation is to increase interest rates, because that makes debt more expensive, it makes it less attractive, and therefore people and companies will generally spend less. That means there's a reduction in demand, and that should bring prices back down. But what do you do when you've got falling inflation? How do you tackle that problem? Well, this chart shows the movement in interest rates in China over the course of the last 12 months. And this shows that 12 months ago, the official rate of interest in China was 3.8%. However, over the course of the last 12 months, China have introduced 3 rate reductions, and the official rate of interest is now 3.55%. However, as we've seen from the inflation data, that clearly isn't solving the problem in terms of falling prices, which are now accelerating. Over the course of the last 3 or 4 months, we have seen a marked increase in the rate of decline of prices. And if we expand this chart to show what's been happening over the last 5 years, you can see that the Chinese authorities have been reducing rates for a long period of time, but it hasn't solved the problem. So China is going to have to find another way of bringing prices back up. This chart shows the movement in the exchange rate between the US dollar and the Chinese yuan over the course of the last 12 months. And as we've discussed before, the traditional way of showing these charts is that the stronger currency is quoted first. So that means that when we see an upward movement in these charts, it indicates that the dollar is strengthening and the yuan is weakening. And what this chart shows is that this time 12 months ago, $1 was trading for around 6.7 Chinese yuan. The exchange rate then fell to a low of $1 to 7.3 Chinese yuan by the start of November as the Chinese economy started to contract. However, in the first part of 2023, we saw a bounce back in the Chinese economy when the outlook started to look a lot more positive and everybody was expecting 2023 to be a super strong year for China. And by the middle of January, $1 was trading for 6.7 Chinese yuan. However, over the course of the last 6 months, we have seen a significant weakening in the Chinese yuan as the economy has started to slow down, and the current exchange rate is $1 for 7.25 Chinese yuan, which represents a fall in value of more than 8% over the course of the last 6 months. And I think the exchange rate is really interesting when you're talking about the Chinese economy, because China is a net exporter. It manufactures lots of goods which it exports all around the world. And when you're a net exporter, your exchange rate has a big influence on the amount of business you're doing. So let's talk about a practical example of a product that's being sold by China that's priced at 6.7 Chinese yuan. This time 12 months ago, that product would have been selling in the USA for $1. However, because the US dollar has now strengthened against the Chinese yuan, that same product priced at 6.7 Chinese yuan would be selling in the USA today for around 92 cents. So the fall in the value of the currency means that China's exports should become relatively cheaper in all of the markets it's selling into. So you would have thought that would be good news for the Chinese economy, because if things are cheaper, they should sell more and therefore make more profit. However, what we're seeing from the data is that that isn't happening. We've got disinflation in the Chinese economy, so prices are falling for Chinese consumers, but we've also got factory gate prices falling. So the actual price that goods are being sold at is going down at the same time as the Chinese yuan is falling in value. So what that means from China's point of view is that when they're selling all of their goods overseas, they're now receiving less foreign currency. Because in the example we talked about, the product that was being sold at 6.7 yuan was previously bringing in $1. However, today it's only bringing in 92 cents. And this means that China is now suffering on a number of different fronts. This chart shows the movement in the Manufacturing Purchasing Managers Index in China over the course of the last 12 months. And if you've been following the channel, you'll know that the Purchasing Managers Index is a survey of thousands of different purchasing managers in a variety of different companies. And the critical score to look at on the index on the right is 50. When the Purchasing Managers Index is above 50, that indicates that businesses are expanding, things are going well, and the purchasing managers are buying in more raw materials in order to produce more goods. However, when the score is below 50, it indicates that there is contraction in those companies, that they are buying less than they were historically, and so the companies are likely to produce less. And what we can see from this chart is that over the course of the last 12 months, there have only been 4 occasions when the PMI was above 50. So that means that on the whole, over the course of the last year, Chinese businesses have been contracting. And if we look specifically at what's happened in 2023, it tells a really interesting story. In January, the PMI came in at 50.1%, so that indicates a very, very small amount of growth. However, in February, the index increased to 52.6%, And at that point, everybody thought that the Chinese economy was back into full steam ahead mode, that this was going to be a fantastic year. We'd released all of the COVID restrictions. Everybody was now working on a full-time basis. And so we expected the Chinese economy to come in with around 6% GDP growth for 2023. However, in March, we started to see indications that that growth was faltering, and the PMI came in at 51.9%. But in April, it dropped to 49.2%. So that's below the 50% level and indicates that on average, Chinese businesses were contracting. That contraction continued in May when the score was recorded at 48.8, and in June the official PMI index is 49, which indicates that Chinese business is still contracting. And this is a major problem for a growth economy which is based predominantly on manufacturing. We are seeing a contraction in the biggest part of the second largest economy in the world. So what's the summary and conclusion today? Well, I wanted to post this video really to give you an update on what's happening in the Chinese economy. And what we're seeing is that there are a number of concerning factors. Firstly, as we looked at today, inflation is now at 0%, which is an incredibly low figure when you compare it to what's happening in the rest of the G20. Inflation has been a major topic for most countries over the course of the last 18 months. And the main focus of those discussions is that inflation was way too high. As a result, firstly, of the COVID-19 pandemic bounce back, and then secondly, Russia's invasion of Ukraine, we saw an increase in commodity prices all across the world. And most economies are still struggling to shake that off. We've got rising interest rates to cool demand to bring prices back down. That has been what most governments around the world have been trying to achieve. But the situation in China is entirely different. Over the course of the last 12 months, China has gone from a very healthy rate of inflation to 0% inflation, no growth in prices whatsoever. And the trend that we've seen over the course of the last 6 months indicates that it's highly likely that China is soon going to move into negative territory, that we will see a fall in prices. And when we looked at the producer price index, the factory gate prices, that tells us that those prices over the last 12 months have fallen 5.4%. And that will feed through into the consumer price index. It will take 3 to 6 months for those factory gate prices to move to the CPI. And what that means from China's point of view is that they're now having to tackle disinflation. The government will need to stimulate the economy to try and bring prices back up. And the problem that China has is that there's now a confidence issue. As prices start to fall, companies become concerned about investing into future development, expanding, producing more goods, because you don't want to sell lots of goods into a falling market. If you've bought all of your stock and raw materials at last year's prices and prices are now falling, it means that you're going to make less profit because you're expecting prices to at least stay flat, if not rise. And if prices are going down, you will have to cut your sales price and therefore you could end up making a loss. So this becomes a really vicious circle from a manufacturing point of view because you want to hold back your goods and wait for prices to go back up. But if that doesn't happen, what do you do in the meantime? Now, the Chinese authorities have been reducing interest rates to try to stimulate demand to actually get prices to go up. But that's been happening for the last 5 years and clearly isn't working. So China is going to have to come up with other ideas as to how to stimulate its economy. And when you look at what's happening with the Chinese yuan, there has been a significant deterioration in value. And as we talked about, that's a major problem for an exporter because it's now bringing in less foreign currency for all of its exports. So that means that this is really a double whammy from China's point of view. And the problem that it has is that when you look at what the purchasing managers are saying, it's likely that things are going to contract further. When you look at the trend of what's happening in inflation, in prices and business confidence, the outlook for the rest of 2023 looks highly negative from China's point of view. And that's obviously bad news for an economy which is expected to achieve somewhere between 5.5% and 6% growth for 2023. Now, in terms of what the impact of all of this will be on the global economy, China is the second largest economy in the world, and it is the second largest by some way behind the USA. So when China starts to slow down, that will have a massive knock-on impact for the rest of the world. China is the world's biggest manufacturer, but it also buys a lot of things in from all of the other countries. So when we see a reduction in China's growth, that will have a domino impact on a lot of other countries. If China's buying less products, that means that all of those other countries will be selling less, they'll generate less profit, they will start to contract, and then they will buy less from other countries, and so it goes on. So the overall summary of today's video is that what's happening in China is obviously a major problem for the Chinese authorities. We are seeing a significant slowdown and a reduction in prices, and unless the Chinese authorities can do something quickly to address that issue, it's likely that the growth for 2023 is going to be significantly less than 5.5%. So that will be bad news for the Chinese economy, but unfortunately it's also going to be bad news for the global economy. So hopefully you've enjoyed today's episode, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.